Good morning, everyone. Christopher Gorman, Rosenberg and Estes, here to moderate this panel to discuss all things distressed real estate.
I'm David Becker. I'm with Time Equities. I'm a head equity strategist and own really all the asset classes throughout the U.S. and Europe: office, retail, industrial, residential, student housing, and the like. And happy to be here.
Hi, good morning, everybody. Stuart Milstein, founder and principal of Drake Street Partners, owner and operator of commercial real estate, primarily office, industrial, and some retail on the East Coast.
Good morning, everyone. Dewan O'Donnell, J.P. Morgan, sit in the commercial and investment bank, leading the distressed special situation opportunities, actively asset managing all of our foreclosed assets.
Matt Scoville, partner at Hunton. Hunton's a full-service law firm with about 1,000 lawyers across the country in major markets. We have 100 real estate lawyers across the country, 30 of which sit in New York. My practice is pretty broad-based. We represent players up and down the capital stack, and fortunately or unfortunately, have a ton of experience, including recent experience, dealing with distressed assets.
Hi, everybody. Brian Flax, Meridian Capital. I manage a team of mortgage brokers, and it seems most of what we work on lately has been also solving problems with some level of distress, although hopefully that's starting to change, which we'll talk about. Look forward to the discussion.
All right, we'll jump right into it. A frequent refrain you hear from those who buy and seek out distressed assets is that there are not enough sellers in the market currently. A question for the panel is how, in the coming months, coming quarters, do you see that changing, and what might be the factors that impact that? Stuart, if you want to start.
Sure, thank you. So I'd say it's I think the way it changes as it goes forward a little bit, following the optimism of the prior panel, is that while the distress is certainly continuing, there's sort of two different types of distress. There is market distress and there's asset distress. I think when people are looking for distressed opportunities, they want asset distress. They're not necessarily looking for market distress. And where I think there are going to be opportunities going forward is that the markets are becoming a little bit less distressed. So you're seeing, New York is sort of leading the charge and certainly making a lot of headlines in terms of the office leasing fundamentals that are going on, and you're seeing vacancy rates go down. The other markets are not quite there, but you're seeing sort of some leasing activity. Chicago, San Francisco, the vacancy rates are still pretty high, but you're seeing at least some of those fundamentals from the market perspective come back. And with the distressed markets easing a little bit, I think people are therefore going to be able to take advantage of the distressed asset opportunities, and there'll be more transactions. And I think sort of transactions beget transactions because there's a deal we were looking at about 18 months ago, let's say. And there was a price that the seller wanted. Nobody hit that price, and they didn't transact. And there were lower prices that were out there. As that market has gotten quote unquote less distress, they are actually willing to take a lower price now because there have been at least other transactions that they can point to say, okay, this deal makes sense. So even though the distress is easing in some of the markets, I do think that the opportunities are going to continue to increase because there are data points for sellers to look at. The markets are improving, which will create those opportunities, and therefore feel good about what is coming and where the opportunities are going to be going forward.
I'll add one thing to that. When you think about the bid-ask spread between the seller and buyer, like you talked about, I think another reason why hopefully that gap is going to get a little tighter is, and again, I'm a debt broker, so we think about the world from a debt perspective as far as the cost of debt, the availability of debt. As rates hopefully keep going down or stabilize a little lower, borrowers and buyers can borrow more money. So hopefully they're going to be willing to kind of creep up a little bit. Right? Because what we've seen is there have been a lot of people that want to sell, but they can't get the price they want. And part of that was because there was really no debt available to get them more than 55, 60, maybe once in a while 65% leverage. And again, as rates are ticking down and lenders are coming back into the market, we're seeing 70%, 75% leverage available, and hopefully that will help the acquisition market pick up a little bit.
Yeah, just jump on that. The real estate market is very different than the stock market. It drips out one by one, and it's very, very deal specific. So a lot of it is just timing related to a particular capital stack, a particular bank, who has deal fatigue, who has new capital, what someone thinks that they can do to recreate the asset or add value, buy it at the right price. So all these factors sort of play into it, and it's one at a time. So there's definitely still that, at least from what we see, a big bid-ask spread, unless there's a forced dynamic, which I think is what Brian's alluding to with a reset of some kind or a forced reset that sort of brings people in and makes people sort of decide what to do. So I think that's part of what's happening. It's been a drip out and, not this tidal wave.
And I would say, just to add, part of the way to get to the discovery or get to the discovery from that throughput you described is certainly specific to the underlying capital structure. So if you think about the majority of these distressed deals, they're laden with debt. And so the question becomes, what is the motivating factor behind the underlying lender and what's the structure of said lender? So if you're thinking non-bank and private versus CMBS versus regional versus regulated, that can all have different varying degrees as to how that trickle effect occurs. And I do agree that once you do get to market with some of this price discovery and transactions begin, others will start to follow suit.
Yeah, just to add on to what Peter said, because I have the same thought, is it's really hard to know what's going on behind the scenes on a distressed deal and what's motivating the parties. It could be pure economics, or it could be a combination of economics and emotion at a certain point. And I have seen, I think over the past 3 or 4 months, deals that have been ripe for unloading or acquiring that are clearly distressed and not going to work, now starting to move. So I don't know if that's a trend. It's just an observation.
Yeah, I'd say what we're seeing is it's a big part the capital stack, but it's also asset specific. About use the phrase from a few years ago. Pretend and extend. That it's driven a lot by, does this asset now need capital? Is there something fundamental to the asset that they can no longer ignore it? They can no longer not react to it because things are just getting worse. So it's sort of a combination of the capital stack along with what's the status of this asset. As leases roll, they start to need capital, deferred maintenance, whatever it may be. Once you got to start writing checks, people's motivations change considerably.
What are the strategies that you folks implement or see your clients implementing to identify and then pursue the acquisition of distressed assets? Matt, I'll start with you.
The first thing is talk to the broker, right? Is see what's going on in the market. If there's anything that's widely available, I mean, that's the obvious one. I think some other strategies we've seen clients employ successfully is really work lender relationships, and really particularly lenders that have some trouble on their books, or that are the lenders on a specific project that's troubled. And really, even if it doesn't work out for a particular deal or a particular time, keep that line open and look for opportunities to get into the deal in the debt, either buying the debt or buying a piece of the debt. And once you have kind of a seat at the table, you get to see a little bit more of what's going on behind the curtain as far as why there isn't a transaction or how you can get yourself into a transaction or at least gain some intelligence. And then I'd say one other thing we're seeing is developers with property management wings are offering services to lenders for REO properties or things that may become REO. And the idea is get in and get the opportunity when it arises to acquire the equity.
Yeah, I would just say, deals come in a variety of forms. We're hunters. We have a brokerage community that brings us opportunities that we evaluate. We have our lending relationships as borrowers that are constantly sort of checking in with us to see what we think about values and whether that creates an opportunity. We have strategic partners throughout the country and a few other countries that will be the local sort of eyes on the ground to sort of help us initially sort of get a read. But mostly it's going through all the details analytically one at a time. It's also having a good understanding. It's where I come in terms of what our capital base is looking for, what they're sort of seeing, what they're sort of like asking us to show them. And so it's a variety of things, but basically it's going back to the fundamentals and evaluating the deals however they come to you and sort of trying to apply your vision and capital and seeing what your future lies.
And I'll come at it from a unique perspective in trying to converge on some of the demand you're describing, in that my pipeline sits from an internal book. And so my priority and goal is to obviously maximize value in a world that, hopefully there's no regulators in the room, will say is held for sale when we're trying to make investments and increase value. And so part of that discussion and equation becomes, how sophisticated are you to get in before a foreclosure happens and can actually look at distressed debt and price it accordingly, subject to the potential problems with the said market or underlying ownership group? And if not, how can you then, and by the way, to your point, can you get in sort of with the bank group at that point, whether singular or syndicate, which can arise a whole other level of complications, which you can talk about offline. But, and then on the flip side of that, if you get in sort of and think about the asset side of the equation, do you have the right either vendors or internal components to get through an execution of a business plan, whether that's lease up, core plus, redevelopment, repositioning, in that sense, value add, or even something beyond that for a heavy renovation or deep dive. And so in my world, I particularly focus on a combination of both, right? Sitting at the table with the lending partners, looking at potential creative solutions prior to foreclosure to do just that. Can we bring in partners or operators before foreclosure that would play nice in the sandbox together and then eventually take over the asset subject to something cooperative, which again, very nuanced from what you probably hear from bulge bracket banks, but I obviously have a different background than probably most REO folks sitting in those seats. And then fast forward, once we do take over the asset, how do we think about not limiting the acquisition opportunities, but even working with brokers to run processes over strategic capital, strategic operators, and getting to, again, an end goal or business plan that gets us back to, on my side of the world, a recovery that was at or maybe even beyond our original lending amount.
And one of the other places that we're seeing opportunities is actually speaking with the borrowers of these assets, because even though technically they might be underwater, they might not have economic value, they still have value because they are still the owner of the asset until it gets foreclosed on, and that's not always that easy. That's not always what lenders want. So reaching out to some of the borrowers and connecting with the borrowers, which are colleagues and potential partners and folks that we work with and bid against on deals and collaborate on deals. And that, we find is a good source of, being able to find opportunities where there's a lender who wants to do a restructuring. I mean, again, it gives you a lot of insight. And even though, I think a lot of folks look and say there's no real economic value to that borrower, why should I talk to him? All the value's in the debt. They have a lot of value. Maybe not as much as they think, but there is value there.
No, I mean, it's always better to, I think, work cohesively with everyone in the stack. And, the existing borrower or owner could have a tax issue. So there's times where we'll offer them a hope note on the back end to push things out. And then you have a collaboration of, okay, you have a vision today, a reset basis, or you come in with preferred equity, and if that borrower, let's say, can help us get full value, appreciation, whatnot for the assets, sort of they can still see some sort of a recovery on their end. So when you have those circumstances, it's always better.
Putting aside New York for the moment, which we'll get to, where nationally are you seeing the most distress, and in what particular asset classes? David, I'll turn that one over to you.
Yeah, we buy. If I stick just to the U.S., obviously the asset class, to no surprise, is office. I think there's a number of seriously impacted office assets out there that require new capital, but that's not even a solution. Where the demand for the space is not there, the buildings are, in many cases, either obsolete or need of serious refurbishment. And even if you did that, the question is, who's home? Is anyone home? And we're in contract now, or about to acquire a large asset downtown Denver. Huge asset, big parking garage, half occupied. I think we're walking in at like a low teens return on half occupancy. The problem, though, is although that sounds unbelievably, and maybe we're buying, the lender's writing it down, 2/3. And our number seems very, very attractive, sort of a sexy deal for a distressed panel, but you got to get it leased up, and you got to add capital, and you got to hold it, and how long does it take, and who's home, and who's there, and what's going on in the market inventory. So, there's those kinds of deals where you don't really know if you're right for a while, and you got to be willing to hang in there and stick it out.
I think in addition to office, surprisingly enough, we're seeing some distress in multifamily around the country, mostly due to people that over-leveraged at the wrong time, equity and debt that just chased the market coming out of COVID in 2021 and 2022. So we're seeing a lot of those deals right now where there's either negotiations going on with the current lender. There's a lot of those deals that are in some stage of foreclosure, and the basis needs to be reset on a lot of those properties. Whereas industrial, I don't know if I've seen an industrial deal in distress personally, and even retail feels very healthy to me. Shopping centers feel full. The malls that are left feel like they're the ones that are successful. So besides office, which I think goes without saying, I'd really answer your question and say that, the multifamily around the country that was over-levered is the asset class that is also having some trouble right now, which presents opportunities for buyers that either, have relationships with those lenders or can figure out a creative way to get into the stack.
I would just add on the industrial side, I'm not sure where you're looking, but we're seeing it on the distress side, primarily in the large box spec buildings that were done pretty aggressively all over the country. Some in strong markets, some in weaker markets where it was just the thing to build, and the supply side is really a challenge there. So there's some significant large box industrial that are sitting vacant. Carrying costs are going up. Loan balances are coming due without sort of tendency to refinance. So that's sort of another piece of the market that I think just from a supply side got a little ahead of itself. From the demand side, I think there is demand, so that helps it. It's just going to take a little bit of time to get through all the vacancy that's there. But in the meantime, there's some debt challenges that are coming up.
From a asset class perspective, we've probably overdrawn the office idea so far, but what I would say is market-wise specifically, we're a bit overweight on places like D.C. Chicago seems to be a bit of a challenge. Atlanta, we're looking at possible deals there. San Francisco. So even in major markets, not just secondary, you're finding some distress. And again, I think it comes down to this flight to quality in office that's occurred over the past 10 years. If you do have a work-from-home environment where it's much less interesting to try and bring people in to get your utilization rates higher, then what are you offering said tenants or said employee base? And many times it's all the bells and whistles that cost an arm and a leg, and you try to justify the best you can from an ROI perspective of how you get pops in rents or shorter downtime or the ability to renew easily. But on some level, it eventually works out in the wash, because what will end up happening is obviously your Class A and A plus properties only have so much supply out there, and so hopefully you get the benefit of some of that uptick in demand from everyone that's left over, and there's not the huge occupier that's in every market today, especially think about places like DC, where by and large the conversation is around government vendors and service providers and the government at large. But you think about 70% of that market is tied up between 5,000 to 8,000 square foot tenants. And so you have to do things like build the spec suites and do a lot of speculative items that no one's necessarily asking for today, but you can tell and sort of read the tea leaves on through what is being taken up and how quickly to try and get sort of better absorption.
I'll say if you have patient capital, you can look at this kind of a market environment and say, well, where do I want to be? And places that are booming, I'll give you an example, which is Nashville, is seeing a huge residential boom, but oversupply of housing. So no one's really looking at land. So we're looking at land, and we have a deal now, a covered land play, where we're grabbing some income downtown, but it's really us. It's really a future development site where you could build some residential towers, 5-7 years out, maybe a little longer, but you're waiting for it. And so no one's really got their eye on the land at the moment, because everyone's either finishing out their supply or licking wounds with whatever else they have. And so we're getting some, I think, reasonable pricing there. And if you believe in the city, and there's other examples certainly around the country where you could certainly get behind a certain city for its growth, I see that as a better opportunity nationally than to just look at the basis in a city that might be on the decline. I'm fearful a lot of the old line cities for some obvious reasons, whereas I'm a little bit more bullish in where population migration seems to want to go, and why resist it?
And in terms of New York specific, do you view it as more of the same, meaning the same issues you see nationally exist here in New York, or does New York have specific, whether it be asset classes or issues that make it somewhat different than acquiring distressed assets in other parts of the country?
Well, the rent stabilized issue in New York City is fairly unique, and I think it's big. It's big for the banks on their balance sheets. It's big because there's been a lot of equity that's been wiped out. It's big because a lot of those buildings you really can't even sell, because people have no idea what the NOI is today and where it's going. They think it could be declining, for a while. So that's one that's unique to New York. And in office, I just think, again, everyone talks about the Class A high-end office is doing pretty well, getting crazy record rents, right, $200 a foot, whatever it is. There's so much class like C+, B-, mid-block office building in New York City, I think way more than any other city in America. So that's, and trying to figure out what's going to happen to that and what to do with that, with those buildings, is a unique issue for New York City as well.
And they can't readily be converted.
Can't be
it's
converted.
like you can't do anything about it without some kind of broader action by government or something.
And it costs more to convert, and it's not the same as new, and it wasn't originally conceived that way. We've done a lot of conversions over the years in New York City, and sometimes New York City rents bail you out, meaning over time or values, but it's no easy task. I think everyone's afraid of answering the direct question.
I'll move on. And I'll ask an easy one, and this is really just your opinion. Where do you think we are in this distress cycle? You've heard people say there's less distress. You see people saying we haven't even touched the tip of the iceberg on the distress. What's your view on where things stand currently?
Yeah, so I'll start with that and maybe try to make this a little more interactive. How many people in the room bought deals last year? Okay. How many people are buying deals this year? So a handful more. How many people plan to buy deals next year? So just from a quick survey, you'll see that it feels seventh inning plus or minus, maybe sixth inning. And on top of that, and it's something I'll coin, so I'll come to you for a residual later, but you think about the 17 plus year run up since the GFC. And now we're at a point where whether it's the fits and starts with the pandemic, regulatory noise, news, whatever you deem it, regional banking crisis, this sort of great resetting instead of recession is now putting us in a position to try to think deeply about where we are and what is next. And I do think that market specific, asset class specific, the folks in this room, the folks on the banking side sort of have to getting back to the original conversation, discovery from bid ask to be in a position to converge. And while we're there, I'll say brass tacks sixth or so, but this was a pretty good indicator.
I'll agree with you with a caveat. We're probably in the sixth or seventh inning. That might be right of a 5-game playoff series. So I think we're much earlier in the process. I think the market distress is you're sort of seeing the end of some of the market distress. Right, New York is an example of that. There's some of the other major markets have sort of seen signs of leasing activity. So I do think the beginning of the market distress is sort of has signs, but the asset side of things, as interest, as people have bought deals at 3% interest rates, as office buildings have been neglected for a number of years, as tenants continue to roll. I think the asset level distress is going to be there for quite a while. The market is coming back and sort of showing signs of improvement, which again in New York, let's say, means it's no longer 25% vacancy on the office side. It's depending on what report you look at, it's 22, it's 18, whatever it is. It's a far cry from the 7 or 8 that it was when a lot of these people, a lot of these assets were born and priced. Besides for the fact that capital is a lot more expensive in terms of lease-up costs. So I think we have a ways to go as we work through the distress. I think there will be a lot more activity and there'll be a lot more transactions. But again, it's sort of what you call distress. But I guess to the extent that it's being sold because the existing capital stack is underwater, because the folks that are there don't have the capital to fund the rest of the business plan. And again, this could be true, again, multifamily in New York specifically, obviously, as we talked about, as its own animal. But I think there are going to be more opportunities. There's still going to be, what I'll call distressed opportunities for a while now.
Yeah, I agree with Stuart, and I like the analogy of sixth inning in a 5-game series. I'll add a caveat to that. We're not even in the playoffs yet. I think there's 100 games going on. And this gets back maybe to the national question, but it's really very asset specific, location specific, tenant specific, et cetera. And I think you're gonna. It wasn't like the market dumped and reset. It really hasn't happened. In fact, I really can't remember the time it has happened. I guess you could go back to 08, 09, 10 maybe, and then before that is years before. So from that point, you like if you look at it to where we are today, I think there's this very slow drip out there, and then something pops and something pops, and so I think it's going to take a long time for markets to actually be valued fairly, and I think there's a number of larger institutions out there that haven't really accepted it or haven't remarked their books yet, and I see this as a long game.
We have, this, maybe we're just involved in a bunch of terrible deals, but we have seen an uptick from the last 6 months to a year on the parties just acknowledging there is no extend and pretend, there's no work, there's no half-cooked workout here. It's a full-on short sale, a tender, a friendly foreclosure, and agreement on the guarantees, or a real workout where half the principal balance is cut, some more equities put in, and it's for 5-10 year horizon. So we've seen an uptick in that for sure in our practice. And again, not sure if it's the deal specific. I think most of them are in the most troubled market, so that's probably some of it. But we have seen some of this action.
I'm trying to be a little bit more optimistic. Hopefully we are working our way through. It is going to be gradual drip, like you said, but I think one of the things to keep in mind, especially to the buyers in the room, is the old real estate saying is true. You don't make money on the sale, you make money on the buy. And right now, if we're in the middle of this and it's going to go on for a while, it presents very good opportunities to buy. And I think we're all going to look back and wish we bought a lot of real estate in 2025, 2026, maybe even 2024. Yeah.
And just maybe a last capstone to your point, even looking at it as a 3-game series, you think about the maturity wall, to your point, and sort of 25, 26, 27, $1.5 trillion coming due, that maybe exacerbates sort of the trickle effect where there has to be some capitulation and sort of, return to normal transaction volume forcibly or not. And I guess the question is, how early can you get to the game to start playing?
Yeah, and I think, though, that's what I'll call in the market overall. There's some, New York City trophy office seems pretty strong right now, both from a leasing and a capital markets perspective, but that's a very small segment of the overall market. You have, different asset class, different qualities, and, different markets that each will trickle out over time in this series.
And then I think maybe a question for you all, and maybe someone in the audience also, where do we think, and maybe it's a question for me more so when I go back to the desk today, but where do you think lending comes out in all of this? Because what we also will start to see is pre-pandemic lease expirations coming due or expiring, and now this idea of consolidated, shorter term, highly flexible tenancy, if you can't grab the large tenant that anchors your building, now your weighted average lease term goes in a building that even probably is great quality with great amenities from a 7+ to a 5.7, and if rates don't come down precipitously quick enough, that then hurts profitability. So curious to see where the lending environment starts to treat the new world order
More
at some
equity.
level. Fair.
Yeah, I would say every time I sign one of those shorter term leases, I think of that, and I'm going to ask you. Yeah, please go back and let me know.
We'll talk.
That actually interesting, the divergence in opinions amongst what inning and what game of the series we're in, for sure. What are some of the unique things that you find yourself underwriting for at this point when you're looking at distressed acquisitions, whether they be market-driven or geopolitical risk? What are some of the things that you're looking at today when underwriting a deal that maybe you were not looking at 4 years ago?
Yeah, I mean, from our perspective and mine personally, I would say the number one thing I would be looking for, which we're buying and sort of trying to center around, is some simplicity, which to me is below market leased industrial. Fairly simple product, downside protected. If you can buy it with more cash, that's better, and not be dependent on the financing markets as much, or at least to be able to option some financing down the road if you have a tenant that you can bring to market. But I think just looking at it, sort of got downside protection, but upside, you have to have patient capital or at least have some time in between to get there, sort of like a lazy man value add deal. And reusable space and land that if, let's say, the world changes, and it's changing with AI and a whole bunch of other data components, to be able to retrofit the space without really having so much capital invested in a project, I think will be useful going forward. That and location, meaning marketplace.
Yeah. I'd say what we're looking at, I'd say more closely than last cycle is releasing costs, both on the office side, even on the industrial side. We do on the retail side, the releasing costs, how much of what exists can be reused, how much is going to cost you, especially to your point about the shorter term leases. That becomes an even more important question, and we're really thinking about that. As I said, even on the industrial side, it's creeping up in terms of what you need to give to the tenants. It doesn't sound like a lot, $3, $4, $5, but when you realize what it might be relative to the rents, it becomes somewhat of an underwriting factor. So that's certainly higher on our list than it used to be as we look at deals.
I was just going to say one quick one. One of the things that's come up a lot on a lot of the loans that I'm working on is on a deal with a business plan and some projections. One of the expense line items that's getting scrutinized and evaluated is the insurance line, because lenders are looking at deals and they're saying, nope, there's no way your insurance cost for that building is going to be that. It's going to be 20%, 30%, 40%, 50% higher than that. And they're engaging insurance consultants and requiring insurance bids, and there's debates about coverage. So I'm finding that has become an underwriting sticking point in the past, 6 months or so, way more than it ever was before, when somebody would just kind of plug in whatever their historical insurance number was, and people would underwrite that. So we're seeing that as a big
So
big
true.
change.
So true.
Yeah, I'd say that from a value add perspective, this balance of optimization versus maximization, this may be music to the ears of some of the operators or capital partners that we bring to the table, but because of this regulatory environment and what Dodd-Frank instituted, we do have this initial 5-year hold period for REO. And so the question becomes, is there worth an extension, which gives you another 5 years? And then if you're going to add incremental 1+1s, you start to sort of comp and look like a closed-end fund that has the ability to be somewhere between 10 to 12 years. And so the question is the juice worth the squeeze to be in a position to deploy capital today, hope that 100-person conference room, new entryway, new retail van and arrival experience helps you down the road, where maybe someone you bring in feels better about the incremental rooftop terrace and lobby blowout, right? And so not aiming for, knowing that, again, you have a sort of captured time period, just aiming for the 22%, and that's actually another good point. Combining that then with the concept of levered versus unlevered, and how do you do that within this framework? And so we'll just talk the unlevered conversation for a second, but if you could be in a 13 or 15 unlevered, because again, as a captured audience, the deal still looks good, down the road have someone else pitch for the 17 to 18 gross, because they can add more and wait 5 years for that top 2 floors to come vacant and create that value proposition for the market. So I'd say combination of optimization versus maximization, and then the levered versus unlevered conversation is really key.
So I generally stay away from the underwriting because my insurance doesn't cover it. But one point is, depending on how you're acquiring and what the distress is, a lot of clients are focused on litigation risk in this, right? There's certainly deals that are really hairy. Some of the parties don't want to transact; they're getting forced into it, and some of them are development deals where you have contractors and architects and other things on the site, and you really got to kind of get your head around, what might happen after you close and how much time it might take for you to put order back.
Before we turn it over for questions, I'm gonna ask what lawyers call a compound question, and I'm gonna direct it at Matt. Matt, what are you seeing as the preferred structures for acquiring distressed assets, whether they be note sales or anything up to post REO? And then more globally for the panel is, what are you seeing as your preferred or desired exit strategies when you are acquiring distressed assets? How long do you plan on holding, or do you not plan on holding, or something in between? So, Matt, I'll start with you on the structure.
Yeah, so quickly, the structures are, you could do what we call an orderly sale, which is the parties agree to a brokered process that usually results in a discounted payoff. That's a non-insider deal. It's a brokered deal. Then you have sort of the insider deals where either the owner or the lender has a relationship with the potential purchaser and sort of pushes that through. Surprisingly, we've seen a bunch of them on the lender side where a lender has identified a preferred client that they'd rather have in the deal, and they're willing to write down a significant amount and release the guarantees in order to get that done. So we've seen that, and then the acquisition of the debt. Oftentimes it's the subordinate debt to try to get in and either have a consensual deal with the sponsor and the senior lender, or foreclose and make a deal with the senior lender, or refi the senior lender. And those have significant complications, and really need to work through how you're going to get to the asset, or at least be confident you're protected for what you put in to get at the table.
Yeah, I mean, from our perspective, we like to get to the asset, and the idea would be to own and operate the asset. So if we're buying the debt, it's likely to somehow get to the asset. And the one thing I'd say is the number of times where we've seen, there's a deed in the box, so don't worry about it, only to find out there's no deed, there's no box, and there's a lot to worry about.
And it's not enforceable.
Yeah, we like to be in the equity, so we have longer-term capital. We're really looking for the upside. We want to be able to operate it, and if not operate it, have a partner that's on our team operating it. Occasionally we'll take a preferred equity position. The problem with preferred equity is you get what you pay for. If it's good, you get a nice yield, and you're capped out. We'd rather cap someone out if we think, if we can be right and wait the time out, or at least own it, get tax benefits. We bring a lot of capital in through the exchange, 1031 exchange markets. They typically have a longer horizon. So for us, it's the equity.
Alluded to it more so in the last question, or answer to the last question, but I think, generally constrained by time horizons, as I mentioned. So we want to be out, hopefully, within 5 years, maybe beyond that to within 10. From an execution standpoint, again, it generally looks as though lease up and/or some form of renovation or repositioning, the ability to sell in a marketed process, or through a buy-sell right with investor that we bring in, or investors we bring in, is potentially on the table. And I don't think we would do BAU just waiting for rates to come down, because of how competitive most of the markets and assets we're dealing with, because of the underlying distress. You effectively lose if you do nothing, and you sort of fall to the bottom of the tiers. So that's generally where we are.
Great. Our time is coming to a close, but before we wrap up, are there any questions from anybody in the audience?
Got a question, raise your hand. We'll go David in the back here.
Hi. So it was brought up as an afterthought on the last panel, but none of you touched on how the impact of AI is going to have on office. And I happen to be maybe more dramatic on that theme, since I've had a history in the added value office business. I just don't understand how anyone could underwrite growth, because the impact of AI is not even known yet. It's only touched the surface, and in my estimation, it's going to be a very big labor disruptor.
Unless office buildings turn into data centers again, but
That's not office anymore, but that's fine.
David, we used to play basketball together. I don't know if you remember that a while ago.
Yes.
Long time. Yeah, long time ago. I agree with you.
Yeah, I agree with you as well, right? Obviously, AI is huge. Its full impact is unknown. But I also think about it a little bit as, everybody said, what's going to happen to law firms now that we have word processors and you don't need, administrative assistants, as many secretaries to work for each attorney, or, other disruptors that have come along the way. densification happened years ago where everybody's like, well, how can you underwrite growth in the office? Everybody's going from 250 square feet per person to 150 square feet per person. There's always disruptors. This one will be there. And it will certainly create, hiccups along the way, but I don't think it's unique in that it's a disruptor. It's a big disruptor now, but I think there have always been disruptors throughout the cycles.
We'll take one more quick one here.
Hi. Brian described a scenario where the asset doesn't have an occupancy problem and the borrower's not mismanaging it. It was just simply over-levered. What are the factors that are going to incentivize a lender to, as Matt put it, stop with pretending and extending and take an action like foreclosing or selling the loan at a discount?
It really goes back to their capital structure, right? And where that capital came from and when it needs to be returned and how much flexibility they have. They will pretend and extend as long as they can. And some of them can do that for a while, and others can't. On the bank side, it also comes down to the regulators and the overall loan book and how much pressure is on them to kind of rebalance their ratios. So they're all kind of working through that. So it really it's very lender specific based on their capital structure and capital source.
Yeah, I think the other factor that determines it is when somebody has to start writing checks. And then, who is it that does that? Because nobody who's out of the money is going to do it. So that's when sort of the rubber meets the road, and I think some decisions need to be made as well.
Awesome. We can end on that note. A couple great questions. Round of applause for our second discussion of the day. We're going to take a break for coffee for about 10, 15 minutes. Reminder, we have two more panels, then we have lunch, and then we've got Coffee and Capital coming up. So stay with us. Coffee and Capital will begin about 12:35, 12:40.